This class is financial management. My name is Kirby Arcundiff. I have a Ph.D. from the University of Illinois at Urbana-Champaign. I'm a chartered financial analyst and a certified financial planner. I currently work as a chief economist and an adjunct professor of accounting and financial management. For this class, we will follow the excellent text by Brigham and Davis, Intermediate Financial Management. And in this lecture, we will cover the first part of Chapter 2 on risk and rate of return. Topics covered in this chapter include basic risk and return concepts, like how do you calculate the rate of return on a stock, standalone risk, the risk of owning one asset, whether a stock, bank account, or bond, and this is generally measured by standard deviation, portfolio or market risk, which is the risk associated with adding one asset to a portfolio of assets, which is generally measured by beta, and risk and return lines and graphs, CAPM and the security market line, and also the concept of market equilibrium and stock market efficiency. This is one of the concepts that we'll use to determine the value of a stock or equity. What we will calculate today will go into the weighted average cost of capital, and it will be the cost of capital component associated with the cost or required rate of return of equity. What are investment returns? Investment returns measure the financial results of an investment, the interest rate you make off a bank account, the rate of return you get off a bond, or whether or not your stock price goes up or down. Returns may be historical. How much did the S&P make over the last 10 years? On average, it's 7-8% plus inflation. Or prospective, anticipated. How much will an individual stock or the stock market go up in the next year? These returns can be expressed in dollar terms or a percent rate of return. I made $100 on my bank account. I made 5% on my bank account. Here is an example. An investment cost $1,000. You sell it after 1 year for $1,100. You have made $100, or 100 divided by 1,000, which is a 10% rate of return. What is investment risk? Well, when you make an investment, at least if it's something like a stock or an investment in a real estate property, you don't really know how much money you're going to make. So investment risk is exposure to the chance of earning less than you anticipate. And the greater the chance of a return far below the expected return or a negative return, the greater risk, and therefore the greater return you should anticipate before being willing to make the investment in the first place. Here is a statistical example. So scenarios and returns for the 10-year zero coupon treasury bond, long-term government debt, over the next year. So if inflation goes up a lot, the bond might drop. If inflation goes down and we enter a recession, the bond price could go up. The worst case, we will say 10% probability of losing 14% of your money. Poor case, 20% losing 4% of your money. Most likely 40% chance of making 6, good chance, 20% chance of making 16, and the very good case, the best case, 10% chance of making 26%. These rates of return and the distribution thereof can be shown on a graph. It's a normal distribution with the highest of 6% in the middle. If it is a continuous probability distribution, unlike the quantized one on the last graph, which would actually be the case for a bond, it looks like a normal distribution like this, again with the peak at 6% and the wings going quickly to a zero probability around -20 on the left and 40% on the right. If we use the quantized numbers, the expected rate of return on this bond, R hat, equals the summation from 1 to n of each probability times each rate of return. So 0.1 times minus 14 plus 0.2 times minus 4 plus 0.4 times 6 plus 0.2 times 16 plus 0.1 times 26% gives us an expected rate of return of 6%. The expected rate of return can also be calculated using Excel, using the sum product function. R hat equals sum product of the list of probabilities, which would be listed in a column next to the list of rate of return. And we will show how to do this in detail in Excel in another video. The sum product multiplies each value in the first array, first column, first row, the range of cells with probabilities, by its corresponding value in the second array. So it sums the products. Consider these probability distributions for two investments. Which one is riskier? Well, they both have the same expected rate of return. They're both centered around 6%, but the blue one is centered far more closely around 6%, whereas the rate of return in the yellow one is far more uncertain. So the yellow investment has a higher standard deviation and therefore a higher risk as an investment. You have more uncertainty about what your rate of return will be. That is standalone risk, which is generally measured by standard deviation. Standard deviation measures the dispersion of possible outcomes. So for a single investment, the standard alone risk is standard deviation. Variance, which is standard deviation squared, can be calculated with the following formula: the summation from I equals 1 to n of the probability of each outcome times each outcome minus the expected rate of return of that outcome squared. So you sum all those up and you get the variance, and then the square root of that, which will always be positive, is the standard deviation. For our example of the T-bond, we have all of our expected rate of returns of 6% here, but each individual rate of return varies from minus 14% to minus 4% up to 26%. We have each of these probabilities, so we take the difference, square it to get rid of all the negatives, multiply by the probability of each one, sum them up, and we get a variance of 0.012. The standard deviation is the square root of that variance, or 10.95%. And just like expected rate of return, variance and standard deviation can be calculated using Excel and the sum product term. In this case, we would have 3 columns or 3 arrays, and we would have sum product of each probability in the first column, for example, times each individual rate of return minus the expected rate of return in the second column, and also the same thing in the third column. So the sum product would multiply first column times second column times third column to give you the variance, and the square root of that is again the standard deviation. We will show this calculation using Excel again in a separate video. So how do we understand the standard deviation? Well, if we look at a normal distribution and we have a standard deviation, outcomes will be more than one standard deviation away from the expected rate of return around 32% of the time. Half of that will be below the expected rate of return, 16% of the time, below R hat minus the standard deviation, and 16% of the time above that are R hat plus the standard deviation. In our example, the expected rate of return is 6%, and the standard deviation is around 11, so 16% of the time the rate of return will be below minus 5, or 6 minus 11, and 16% of the time the rate of return will be above 17, or 6 plus 11. This is useful for comparing different investments. Investments with bigger standard deviations have more risk. That doesn't mean you shouldn't invest in them, but you should know the risk going in. And if there's more risk in an investment, you should expect a higher rate of return as compensation for taking on that investment. When analysts use historical data, they will generally calculate something like a standard deviation for maybe the last 5 years, depends on the analyst. In reality, since business cycles commonly last 15 years, you should probably use longer data. This is a table from one of my articles on seeking alpha. It is a list of past bear markets since 1980 using the Wilshire 5000. The most recent bear I've called dot-com bubble 2.0, and it involved a pullback of 26% over 10 months starting in December of 2021. Before that, we had the very quick pullback and recovery from COVID of 30%, only lasting 1 month in February of 20. Before that, we had the housing bubble burst and a very large stock market drop of 56% over 17 months, starting in October of 2007. And then we had the first dot-com bubble drop of roughly 50% starting in March of 2000. Then we had the early 90s recession, a drop of 20% starting in July of 90, which lasted 3 months. Black Monday of 34% in August of 87, linked 3 months. And the early 80s recession, a drop of 27% over 21 months starting in November of 80. You can see from this, sometimes bear markets occur frequently within a couple of years of each other. Other times you might not have one for 7 years, or 10 years, or 13 years. So only looking at a few years' data to measure risk is not a good idea. Probably at least a 10 or 15-year time frame would be useful. If we use historical returns, this slightly changes our formulas for reasons which you would learn in more detail in a statistics class. You so-called lose a degree of freedom when calculating standard deviation. So the average rate of return is the summation of each of the rates of return divided by the number of years or the number of months in which they took place. The standard deviation of the sample is the summation of each average rate of return subtracted from each individual rate of return squared divided by the number of time periods, whether it is months or years, minus 1, which is pretty tedious to calculate by hand, but very easy in Excel. You can also calculate the average return during a time period of sample data and the standard deviation using Excel functions. For example, the average is just the average of the sample data, perhaps presented in a column, say A1 colon A30, and the standard deviation is going to be calculated in a similar way, STDEV A1 colon A30. Now let's consider some historical data for both market rates of return and stocks. Say we're looking at the past 10 years, and we have the market rate of return measured by either the S&P 500 or the Wilshire 5000 in our first column, the stock Blandy in our second column, and Grammage in our third column. Using the data previously presented and our Excel equations, which we will show in detail in another video, we get the following results for the average rate of return and standard deviation. The market gets a rate of return of 8, Blandy 6.4, and Gramage 9.2. Whereas the standard deviation of the market is the lowest of 20, Blandy gets a lower rate of return, but a higher standard deviation of 25, and Gramage gets a higher rate of return and a higher standard deviation of 38. So on a standalone basis, Gramage has a higher rate of return and a higher risk than Blandy, but of course the market overall lowers standard deviations significantly, but gets a rate of return between the two stocks. So how risky is Blandy stocks? If the returns are normally distributed, the standard deviation is 25, the expected return is 7, so 16% of the time the return will be below 7 minus 25.2, or below 18% loss, whereas 16% of the time the rate of return will be above 32%, or above the expected rate of return of 7 plus 25.2, or 32.2%. So this is a risky stock, and stocks in general, particularly individual stocks, are very risky. Now let's consider portfolio returns. The percentage of a portfolio's value that is invested in stock I is denoted by the weight WI. The sum of all these weights must be equal to 1. If we have N stocks in a portfolio, its return must equal the summation from I equals 1 to N of WI R sub I. For example, if we form a two-stock portfolio by selling 25% of the Blandy stock and investing it in the higher risk Gramage stock, the portfolio return each year will be the weight in Blandy, which is 75%, times the rate of return of Blandy, plus 25% times the rate of return of Gramage. So our portfolio of Blandy and Gramage, again, if we go back, it's 75% Blandy, 25% Gramage. So in year one, it will be 75 times 26 plus 25 times 47, which is 31.3%. We will do this each year. So in year 10, 75 times 28 plus 25 times 75 gives us 39.8%. So we get these rates of return for this portfolio in each year. So after we do our calculations, we find that the portfolio's rate of return is 7.1%, and its standard deviation is 22.2%. Now, the rate of return is a weighted average of the rate of return of both stocks. 0.75 times 6.4 plus 0.25 times 9.2 gives us 7.1, but the portfolio's standard deviation is lower than the weighted average of the standard deviation of the individual stocks. 0.75 times 25.2 plus 0.25 times 38.6 gives us 28.6. We are therefore getting the benefits of the higher rate of return of Gramage in the portfolio while actually getting a lower risk by adding it. Why would this be? And the answer is the two stocks aren't completely correlated. So if we look at the returns of these two stocks over time, we have the blue line, the volatile Gramage stock, going up and down year by year, and the Blandy stock going up and down year by year. But in some time periods, when one goes up, the other one goes down, and they don't go up and down by the same amount. This lack of correlation allows an investor to gain benefits from diversification and get a higher rate of return, well, they get a lower risk. The correlation coefficient can be calculated with the shown formula below, the summation over each year of the rate of return of a stock minus its average times the rate of return of a second stock minus its average, then divided by the standard deviation of each stock. These correlation coefficients will not, in general, be 1, so you can get a benefit through diversification. For example, Blandy and Gourmage are very uncorrelated at 0.11. The ideal would be negative correlation, but that does not occur very often. Let's consider a two-stock portfolio. The ideal circumstance for an investor would be to have a row or correlation coefficient of -1. You can then combine the two stocks and form a riskless portfolio while still having a rate of return. Some hedge funds try and find these sort of things, but of course they very rarely exist, and you are not going to be able to get that kind of benefit from diversification. The worst circumstance would be a row or correlation coefficient equal to 1, and then risk is not reduced at all through diversification. This would be a highly unusual circumstance, might occur if you have one stock buying out another stock, and then row could be close to 1. The normal situation would be a row between -1 and +1, and then you would be able to reduce risk through diversification, but it certainly would not be eliminated. What happens to the risk of an average stock as you add more stocks to the portfolio? Well, the standard deviation decreases because the added stocks are not perfectly correlated. You end up with a graph that looks like this, where we start out with one stock having a very high rate of return of 35%, and as you add more and more stocks, the portfolio's risk goes down. Average for the S&P 500 is maybe 20%. If you add international stocks, then you might be able to get a risk somewhat below this. So for the first few stocks, you get a huge benefit from diversification. After something like 30, 40 stocks, the benefit goes down significantly, and you are left with market risk as opposed to company-specific or individual stock risk. If we consider an individual stock, its standalone risk can therefore be split up into two components: the market risk, which we will later on measure by beta, and the diversifiable risk. So the market risk is that part of the security's standalone risk that cannot be eliminated by diversification. The firm's specific risk, or diversifiable risk, is that part of the security's standalone risk which can be eliminated by diversification. As more stocks are added, each new stock has a smaller risk-reducing impact on the portfolio. The standard deviation of the portfolio at first drops off very quickly, but then very slowly as more stocks are added. So by forming well-diversified portfolios, investors can eliminate about half of the risk of owning an individual stock. Can an investor holding one stock earn a return commensurate with its risk? No, because most investors will diversify. Investors bear only market risk, so prices and returns reflect the amount of market risk an individual stock brings to a portfolio, not the standalone risk. In general, investors are not compensated for just holding individual risky stocks. Of course, the best way to get wealthy in the United States is by starting a company, and in this case, you will have very concentrated risk in that company if it succeeds. How do you measure the amount of market risk that an individual stock brings to a well-diversified portfolio? William Sharpe developed the capital asset pricing model to answer this question. So market risk is defined by CAPM. We'll use the concept of beta. We will define WI as the percentage of the portfolio invested in stock I. Sigma M is the standard deviation of the market, not the individual stock. Rho IM is the correlation between stock I and the market. So the contribution of stock I to the standard deviation of a well-diversified portfolio is going to be the weighting in the stock times the standard deviation of the market times this term here, which is going to be the correlation of the stock with the market times the standard deviation of the individual stock over the weighting of the market, and we will define that term as beta. So that is the beta of the stock, and then rewriting our equation, the contribution of stock I to the standard deviation of a well-diversified portfolio is the weighting in I, the market standard deviation, times the beta of that stock relative to the market. So the stocks that contribute more risk, like a high-tech stock, will have a high beta, and the stocks that contribute lower risk, like a public utility, will have a lower beta. Thank you for watching this lecture. We will continue it in the next video.